In this video, we're going to walk through Lemonade's shareholder letter for Q2 2022, give you my highlights, my analysis. So some of the big highlights: $458 million in-force premium, $290 premium per customer, 1.58 million total customers, 107 million gross earned premium, and a gross loss ratio of 86%. Some of the numbers I was forecasting, again, you can find this on my Patreon, but 1.56 million customers, 288 premium per customer, in-force premium of 450 million, and 104 of gross earned premium. So very close. I also had a gross loss ratio. I was kind of guessing, but I was thinking maybe 85%, so quite in line with that. In short, the second quarter was strong. This was a fantastic quarter. I love the guidance and strategy they're taking, which we'll get into in a second, but I was kind of expecting this might be a stronger quarter. And I have been buying more shares a little bit more aggressively, and I think I will be, especially after this quarter. Not financial advice, but a couple things I have been tracking is the iPhone app ranking in the iPhone iOS store for Lemonade has been slowly climbing up. And then Value Investor also had good data, if you look back in previous months, even before May, that Lemonade was at a higher ranking and has slowly been climbing the charts in the App Store. Also, another thing I've been tracking is just Google Trends for Lemonade Insurance in the US has been slowly climbing higher and higher. It's pretty significant, actually. If you pull this up here, this point right here is around their IPO, and it's just a little bit less than 75% of where the search interest is right now for Lemonade Insurance. So it kind of tells you maybe they're just getting more and more traction in the market, and this might be a good quarter. A couple small signals that might have told us this was a strong quarter. Next point is that cross-sells trended up. 23% of sales in Q2 were from cross-sells and upsells. And this is part of the Lemonade thesis. There's lots of other insurtech companies out there that are trying to take a really efficient kind of approach to insurance. But most are really, all of the ones I've seen they take an approach, they're sort of tackling one problem. Like they're going to tackle one insurance product, because that in and of itself is a big problem. Or you could, you tackle car insurance, or you tackle home insurance, and that's sort of your product and your target thing that you're going to try and do really well. But the advantage Lemonade has, if they can sort of have every product that a retail consumer may eventually need or want, they have better chance of bundling those between customers, and also better chance of knowing if they think a customer is less likely to file a claim, they really want that customer, and they can even offer maybe better or more aggressive pricing to those customers and keep them and still be maybe even more profitable than another customer. So there's big advantages to being able to sort of own the entire ecosystem. You own the flywheel. From top to bottom, you're vertically integrated, and you offer all the services, the full package, full solution someone might need. There's huge benefits, I think, in just about any business, but certainly in insurance. Okay, this is another big one. The loss ratio trended down, improved 10% in the last 2 quarters. There was some spikes and a lot of concerns a few quarters ago, but that is trending down around that mid 80 mark. I think it was 86%. So that's very, very encouraging to see. Now, I just love in the letter the confidence that they're stating this path to profitability. They just give us a lot more detail in this letter, and that's why I just get so excited reading this earnings report. Our customers and products continue to season. We expect returns from earlier investments will soon outstrip costs of new ones. Accordingly, peak losses are expected this quarter, and that's what they said even 6-9 months ago. I think it was like the end of for Q4 of last year, they were saying, we think we're 6 to 9 months away from peak losses, and EBITDA is expected to improve thereafter through to profitability. So I was modeling, that was kind of what I was I was using a lot of that to frame some my own model here that I've shown in other videos. I will be updating my model probably later this week, and then presenting that to you all. You can also sort of see my updates if you join my Patreon, or see the whole model in detail if you want to jump on my Patreon. Okay. Fully funded, we've moderated our growth, spend, and hiring pace, and expect our existing capital to suffice until we're profitable. Again, another huge point, and just the way they go into a little more detail later on, but the way they state this so confidently, oh man, makes you very excited as an investor. Because obviously for Lemonade, in my mind, Lemonade, the biggest issue is, are they going to make it? Are they going to make it? Are they going to execute? Is the plan the plan makes sense on paper. The plan makes sense in your head. All the qualities of the company they've built, they make sense, but are they actually going to be executed well enough, or are they going to sort of fumble the ball and fail? We really don't know as investors, and that's the huge risk, that maybe this company doesn't make it and they go bankrupt. But just the way the writing in this letter and how confident they are gives me a ton of confidence that they know the metrics they're seeing in detail are really showing them, yeah, they're going to make it and they're going to be profitable. And of course, if they are profitable, what I've been sort of banging the gong or banging the drum about, and I will keep banging the drum about, is I believe the market does not understand how big of an upside there is. I did one of my portfolio videos, I showed, maybe them getting to $200 to $300 billion market cap by the mid 2030s. But really, that was still, like, according to, you look at the whole worldwide market, they could go much bigger even than that model shows. I don't think like several hundred billion, even $1 trillion someday is impossible. I'm not saying that's going to happen, but I don't think that's impossible. And certainly a few $100 billion doing it 100x, 200x, 300x from where we are right now, where we're sitting at, we're around $1 billion. Now we're at like $2 billion market cap. I think the upside on Lemonade is so huge. You're going to be hearing me bang that drum, because I don't think the market understands how big the potential could be, because they are a company that's built to scale, to grow rapidly. Once everything's in place, and as they're saying, they think they have all the money they need in place. They have the path of profitability in place. They've made the huge investments that they've needed to make already. Okay, next point. Metromile acquisition closed. In return, for approximately $145 million in stock, we received a business with $155 million in cash, $110 million in in-force premium, and 49 state licenses, data from 500 million road trips. So amazing acquisition that they pulled off. They have a lot of work, which they go to later on here in the letter, of just merging those companies together. And they give a little more color here to the whole global picture. Also, giving us more, again, very, very strong language all throughout this report. Very, very encouraging language. As they mentioned, our screens are showing strong demand, marketing ahead of plan, operational efficiencies continuing their ascent, and loss ratios continuing their descent. And then they're going to go on to talk about inflation and cost of capital. This is an amazing line as they're talking about the inflationary environment they're in. They say, we believe we've taken appropriate measures to mitigate this threat, inflation threat, including about 100 rate filings in the last 12 months, and indeed are seeing their impact in our moderating loss ratios, basically adjusting their pricing through a rate filing. And I think this just goes to show a company like Lemonade that's so strategically built on such a digital platform can be very lean and very nimble, and can do a lot of things like this effectively, efficiently in a short span of time. And they can adjust to what's thrown at them, which to me, that's just a sign of a tremendous business that can adapt and adjust to the ever-changing market around them. Now we're going to get into cost of capital. They talk about doing the raise back in January 2021 when the stock was near its high. Very smart move again by management. They've made some really tremendous moves. And now they talk about how, really growth stocks have been absolutely crushed in recent months. And so the cost of capital, if they needed to get more capital, of course, goes up. So this is a big point right here. It says, in recent months, we have made adjustments to our plan with the goal of ensuring we are never forced to raise capital. In the service of this goal, we have moderated our growth, spend, and hiring pace, with 3 notable consequences. And I actually couldn't find the tweets. I was trying to dig them up. So let me know if you see them, but it doesn't matter. They're from about a month ago. I remember me and 2 other really great Lemonade bulls were on Twitter discussing this very idea and really in favor of it. I know, at least I remember being in favor of this, and I am in favor of this, that if they feel they can avoid ever having to do another capital raise, and all it means is they have to grow a little bit slower in the next couple years, and then once they become profitable and those profits start growing, I'm sure they will accelerate their growth within that profitability framework. But if they can do that without never needing to raise capital, I think that's a really, really smart move. The only concern I would have doing something like that, like slowing down your growth, It would be if there was another another company doing a similar strategy that Lemonade is doing, where they're trying to offer the entire insurance package all in this digital structure. If there was a company doing something like that, then, and right, on their heels or just starting and growing as quickly as they could, then I would be more concerned, and I might be smarter to take the really aggressive growth. But really, there are no companies, like that. Who's going to catch Lemonade? It's difficult to start an insurance company. There's difficult regulatory loophole or hoops you have to jump through to get any sort of product to market. So it's a challenging, difficult industry, but now Lemonade's built the whole structure and built the product lineup. Like, it's okay if they grow a little bit slower if it means they're never forced to raise capital. So I'm very excited. I think this is a great move. So EBITDA is going to be a little bit better because they're going to be going towards profitability sooner. So that makes sense. In-force premium is going to be a little bit worse, which makes sense because they're not going to be growing quite as aggressively as they might have otherwise. And then finally, just what they said above, we plan to manage our capital to achieve profitability without requiring a further infusion of capital. Absolutely amazing. They give this nice analogy about basically taking your foot off the gas. So you save some gas in the end because gas is more expensive, just like the cost of capital is more expensive. So they give that nice little analogy there as kind of what they're doing. And they do go on to say, we can effectively deploy far more capital than this moderate plan will in fact see us deploy, just not at today's cost of capital. So I think what they're basically saying is, like, say the stock rebounds and goes on an absolute tear in the next 6 months to a year. They're not against raising a few $1 billion more and then using that money to spread and advance their growth at a much faster clip. So I think they might even be being a little bit secretive here. They're saying, they're telling us exactly what they're going to do, but they're also saying very strongly, we plan to never raise money again, which I think they're being serious about. But they're also sort of saying, but if the stock goes crazy, parabolic, maybe we would raise some money. So they're kind of, which would make absolute sense, and I would be in favor of that too, if they could raise, say, another $1 billion in a year's time, and the stock's back at 150 or something like that. I would be all for that, just so that they could help push their growth even faster. Then they're talking about the Metromile deal. So a couple of highlights here. This was recently, they did, right after the deal went down, they laid off about 20% of Metromile staff. So they're planning to keep about 80% of these staff. They'll be integrating in. And this is interesting. Renters insurance now comprises only about a third of their book, down from half, so it becomes less and less significant in the whole book of business, while car jumps from 1% to 20% overnight. So a big jump there. This is an interesting nugget. They also say this during this transitional time with Metromile, until we can offer a unified Lemonade car, we expect to expend little to no marketing dollars on acquiring new customers to Metromile. Interesting. So maybe still their Lemonade car product, maybe they'll be attracting customers there and maybe putting that into more states, but not trying to actively push the old Metromile model, of course. And he says we anticipate car to represent a somewhat declining portion of our book in the second half, given the natural churn inherent in the business. So interesting. Maybe car in the second half this year is not going to be as significant as one may have thought before. This is actually the top voted say question for tomorrow. I said, how aggressively can we expect Lemonade car to be rolled out in terms of availability and customer count? When do you expect it to be available in most states? And approximately, specifically the big three, California, Texas, New York, and approximately how many car customers can we expect you to have in 12 months? So this is a key question I want to know. Hopefully they can give us a bit of a good answer on. So we get sort of a numerical answer and say, okay, here's sort of what they're thinking for car rollout. So now cross-sells and upsells, as I mentioned earlier, big part of the Lemonade thesis is that they're selling all the products a consumer might want. And so you can bundle those together. And of course, they get underwriting advantages as they know more about you and your risk profiles across different products. But even as a customer, you're more satisfied and happy to just stick with Lemonade because they have all the products you might need. And here's an interesting little graph of quarter by quarter percent of sales excluding car. So they're cutting out car just because it's a new product and probably because of the Metromile acquisition. But otherwise they say percent of sales that were cross-sells or upsells, so going from 17% to 21% in this quarter. And then the continued rollout of CAR, though, promises to spike these numbers because, of course, if you already have homeowners insurance, now you just want to, and you love the product and it's great and a competitive price, now you just sign up for your car insurance, boom, it's easy to cross-sell those customers. And we're in Illinois, where they've been testing Lemonade Car for a few quarters, 36% of all Lemonade sales were cross-sells or upsells, or quite a bit higher than this number, and annual dollar retention was 93%. Excellent. Then they talk about, again, more detail on their path to profitability, this very strong, encouraging language as an investor, that much of their book of business is seasoned and customers that are less likely to churn, that are more stable, that are signing up for the new products like cars, they come out, and then that continues to grow over time as these customers are there and they get older, and they can eventually shift the whole book of business into profitability because you're spending less money on just trying to grow and get new customers. Then again, he says, we expect our losses to peak this quarter and continue to shrink thereafter, charting a clear path to profitability. This is fantastic. It says, we plan to hold an Investor Day in November 2022, during which we will more fully unpack our path to profitability and show the leading indicators we use to run our business on a day-to-day, product-by-product basis. These are driven by machine learning models and lay bare the dynamics underlying our business and offer helpful and promising predictions for its future, which is fantastic. For a few quarters ago, I was asking for something like this to really reveal more under the hood metrics and details, just to help give us as investors more confidence. And then I was predicting, just based on different commentary, I was predicting in a video a couple days ago that they were going to do this a kind of an analyst day. And part of my prediction there was I thought they were going to try and, promote the stock price, just so that they could have a better chance to raise money in the future. And from the commentary in this letter, it would be assumed that maybe that's not the reason they're doing Investor Day, but I think actually might still be kind of the reason, because they did say, hey, if our cost of capital does go down because the stock price rises, we might still raise money. So there might be sort of a secret hidden way. Of course, they want investors to have confidence in them. And the stock price to be higher is better. Talks about the loss ratio, how that has been descending down, and they expect that to continue to descend down. Also, Metromile has had higher loss ratios, and now it's about 20% of their whole book. So this is going to add 3 to 5% in the coming quarters. And they do expect, just like other product lines, and I hope they share some of this information at that Investor Analyst Day, is that the loss ratio of our expanded car book, they expect to follow a downward trajectory similar to the rest of the business. And they don't expect Metromile's higher loss ratios to delay their peak losses. Again, very strong, very encouraging language. And then they get into their LTV6, their 6th generation lifetime value machine learning model. And this model offers a prediction of a customer's likelihood to churn, to claim, or to cross-sell. And from these, it derives a predicted lifetime value. Basically, they're taking all the information they know about you, all the different thousands of data points that Lemonade talks about that they can, just as you interact with the app and how you sign up and what you read and check and not check, and those kind of informations and what time of day it was at, and then of course all the other sort of proxy information about you, I'm sure that they could gather or would have gathered through your profile and information you give them. They basically create a statistical model that says, yeah, you're this likely or this likely or this likely to churn, claim, or cross-sell. And then they're continuing to improve that over time as the actual results come through. It says, oh, I thought you're going to churn and you did churn, so this was good. Or they thought you're going to churn and you didn't churn, so maybe this was bad. Or this sort of part of the model was bad, and then they're going to tweak and improve this model over time. And I'm sure we'll see this number 6 go even higher and higher as they make these models even better. And again, they talk about how LTV6 is significantly better over LTV5 because they have so much more data, and now even claims and customers that are churning, they have the actual results that they can then feed back in and make this new model much better than the old one. They make an analogy about this almost like taking over a new NASA telescope, and you can see further and better and clearer than you thought. What you thought was great before, now you can see even better and clearer. They give an example here how LTV5, versus LTV6. LTV6 was flagging some homeowner policies, so I'm sure they fit a certain kind of profile, certain maybe location they live, certain type of, profile of a person that are saying these people actually might not be very profitable over time. So we're going to shift our marketing away from them and instead into more pet insurance across several other states that are going to be more profitable long term. And of course, these are all lagging indicators. It's again why that investor day is going to be so important in November, to see that, to know that, because they might give us even more concrete examples, kind of like the above, but even more detail to show the decisions they're making and the impact they're making. They talk about the amount of data that's going on here. In the 12 months since then, we have handled twice as many claims as we did in the first 4 years combined. During those 12 months, we also pushed 12,000 software builds into production. So about 1,000 software iterations. This is so awesome. Just shows the amount of data they have to improve their models is scaling bigger and bigger as they get bigger. That's kind of why they have this potential massive flywheel. If they grow big enough, successful enough, they could dominate the insurance market potentially around the world. And that's why the upside on a company like Lemonade is just so huge if they get the flywheel right, spinning so smoothly, so effectively, and then growing that advantage over time. That network effect grows as you have more and more customers feeding in the data. Your models get better, and then you can make even clearer, better decisions than anybody else. And anybody who tries to come and follow you later on and copy you, it's tough to follow and copy somebody who's already there and doing it effectively and winning the hearts and minds of customers. But amazing that, once again, amazing that they did in 12 months, they did twice as many claims as the first 4 years, and they did during the last 12 months, they did 12,000 software builds. Just incredible. You compare that to a legacy insurance company, I'm sure, the type of software they're using and implementing and the structure that's built around it, there's no way they do anything even remotely close to the kind of tweaks and changes and nimbleness that's available to a company like Lemonade. And so then it's talking about how the loss ratios you are seeing are a lagging indicator and not really accurate to what is seen right now. And that's partly why I do believe them. The management, when they say they're making these bold, clear projections about they're going to be, this is the worst quarter coming up of losses, and then they're going to be profitable, and they're not going to have to raise money because they're seeing the metrics and information that's current to today right now, while we're only seeing these kind of lagging indicators. As a Canadian, you got to love the Wayne Gretzky comment here, must skate to where the puck is going to be, not where it has been. And it talks about, this is a very interesting subject, talks about how customers' loss ratio tends to decline over time. So if you have a cohort of customers over time, I'm sure some of those customers churn or leave, or Lemonade doesn't renew or gets rid of them. But over time, then their actual loss ratio tends to decline. So they kind of have a split where they find the average loss ratio overall for the whole lifetime of those customers is after around 2 years. So again, you have more upfront costs as you're getting customers and sorting through customers. And then as you keep those customers and they're not churning as much and they have more stable lives and they're just keeping the same products year after year, you have much better loss ratios and they may have less chance of having even a claim further on because maybe they're more responsible, more stable people. Could go on and on. And then basically just goes on a little more detail about how, again, loss ratios decline as the customers, each cohort sticks around with them. And they give this very interesting chart. This is a lot of the details expecting at the analyst day, but they're giving us lots of it here already, so very exciting. Is the projected lifetime loss ratio per cohort over time. So over 6 quarters of data, they're showing projecting about 86% all the way down to 68%. And it is possible for Lemonade to have loss ratios lower than their give back kind of percentage of 75%. So say Lemonade takes about 25% of the whole pie as their cut for administration and profit, but of the remaining 75%, part of that they use that to pay out their claims, and anything left over gets sent to the give back. But they also mention in their give back kind of details that only up to 40% of a person's claim or of their premium could go towards a give back. So that means they actually could have loss ratios overall better than that 75% metric. So could be down into the 60% range. And then they talk about, again, this very strong, encouraging language. It gives us the confidence to reiterate our expectation that our business will operate on a multi-year average loss ratio below 75%. So I'm going to have to update my model to actually start bringing that down below 75%. In a deep sense, it already is. Then they talk about reinsurance, that they've dropped that down. They dropped it from 75%, I forget, it was about 72%, and now they've dropped that down to about 55%. So that means they have a little more risk they're taking on themselves as a whole insurance company, but there's also a little more reward left over. I did ask Daniel this question, that if reinsurance is at 55%, approximately what factor of IFP to surplus capital will you need to hold? Would be great if you could touch on this in the call tomorrow. So we'll see if Daniel or Tim or Shai gives an answer about this. I'd love to see that. Right now, it's about a 7-to-1 ratio, which is one of the advantages of having all the reinsurance in place, is that they only need about $1 for every $7 of in-force premium that they carry. But now that ratio, I'm sure, is going to shift a little bit, that they need to have more than just a 7-to-1. And that's going to just about do it for this video. I'll be doing more commentary tomorrow after the earnings call comes out. And it really did feel like LeBron reading this letter, that yes, the thesis is starting to play out. The confidence that the management has and that they are conveying in this letter is just beautiful. So I'm very, very excited. I don't think I've ever been more excited for the future of Lemonade. And if you enjoyed this video, make sure to check out my Patreon. You do get full access to my Lemonade model and every update I'm making it, even as I'm making it with the Patreon membership. So if you want to support the channel, feel free to check that out. And you can also find me on Twitter at PaperBagInvest. And remember, it's in the bag.